Welcome to Theo Trade and the Weekend Update. This is Don Kaufman here on October 7th, 2017. First, a look back, what can only be described as the unstoppable move to the upside in markets. I'm going to get right to it here with the SPX. There's also what I'm going to talk about here on this Weekend Update. I'm going to, if you will, geek out for a few minutes on this Weekend Update. So for those of you that have a bit more experience in trading, I think I'm going to show you some pretty fascinating areas that, quite frankly, in 19 years of trading, I have not seen some of these areas stretched as far as we currently are. And for those of you that are into technical analysis, no, I'm not going to be talking about technical analysis. No, I'm not going to be talking about the fact that markets are necessarily stretched to the upside. I'm actually going to show you some quite interesting areas in the option trading and how options are priced that are at absolute extremes right now and really inexplicable. So let's start with this review of the most recent move to the upside. Now, the way I'm going to look at this, again, is not from a technical standpoint. Why? Hey, newsflash, we're trading to the upside. I mean, everybody ultimately sees that. But the one area that's striking to me in this most recent rally is that there's a breakdown of efficiency in the marketplace. And what I'll define efficiency in the marketplace, for those of you that do tune in kind of on a week-to-week basis or even a day-to-day basis, we've got nightly videos that we're doing here. But if you're just tuning into the weekend videos, I often talk about these expected moves. And what expected move is derived from, it's derived, of course, from the option premiums. So with the SPX, for example, we can take a look at the SPX and we can cruise out already to next week. What's next week? Well, this is a Monday expiration, a Wednesday expiration, and I'll kind of highlight them on your screen here. So there's the Monday, there's the Wednesday, there's the Friday expiration. So for the next 6 days, the option markets, okay, are expecting about a $20 move, $20.52, either higher or lower. So I take this expected move and I actually plot it, okay, specifically on the chart. And this is, again, forward looking, right? So each and every weekend we come in here and we say, all right, well, here we are right now at what? 25.49, and we're expecting to move 20 points higher or lower. Go fish, right? When I say go fish, I mean, well, let's see what we do. Well, if you take back, a look back, I should say, at all of the expected moves that we have kind of drawn on the chart. And again, these are all hand drawn. Yes, we have studies that can auto draw the expected moves, but in this particular instance, I want to take you back to what I've actually hand drawn. When you look at an expected move, you're supposed to stay inside of that range. And when I say that range, I'm talking about this bracketed region, right? These bracketed regions, you're supposed to stay inside this range approximately, okay? And it's one standard deviation. Now, one standard deviation, what does that actually amount to? And one standard deviation amounts to about 68.3% of the time. Now, this is where I said I'm going to geek out on you guys a little bit. So 68% of the time, we're supposed to stay in this region, if you will, on a week-to-week basis. And anytime that we crack out of that region at the end of the week, again, the end of the week, all right, what I'll do is I'll actually highlight it like right here, okay, right over here. And one of the things that I'm seeing in the marketplace in the most recent weeks is going from a period of incredible efficiency. Okay, there was a huge period of time where, weeks and weeks and weeks, we never cracked outside the expected move. And if we did crack outside the expected move, we would run right back in it. Again, these lines on the screen, this expected move, it doesn't say, and I want to make this just crystal clear, okay? This doesn't say that we can't crack outside it. What it's saying is that there's a 68% chance that by the end of the week, we're going to be back inside of that range. Okay. And what we found is if you looked back over 3 years, and I'll even turn this off for a second, turn off all the lines, and here's an auto expected move. This is automatically driving the expected moves. You look back over like a 3-year period of time, okay, what you'll actually find out doing a lot of research is we're staying inside of the expected move substantially more often than we should. Meaning, okay, and again, this stuff gets pretty deep, right? For a weekend report, you're like, okay, when are we gonna get to what does the Bollinger Band say? Forget that stuff for right now. I'm talking about like efficiency of the marketplace. So we're supposed to stay inside this thing about 68% of the time. But if you look back over the last 3 years, we're upwards now of 83% of the time that we're actually staying inside of those expected moves. However, okay, in the most recent weeks, we're displaying now signs of inefficiency. What does inefficiency mean? It means, okay, for the most part, you look back, you count back 1, 2, 3, 4, 5, like 6 weeks. Well, right here off the top of my head here, 7 weeks, 8 weeks. In the last 8 weeks, we got 1, 2, 3, 4 breaches of expected move. All of a sudden, we're outside the expected move like 50% of the time. What gives? Okay, and that's something that we're not just seeing in the SPX. Okay, I track this stuff in the NASDAQ. All right, this is the Qs. So we can actually turn on the drawing set inside of the Qs. Okay, I track this stuff in the IWM. The IWM is shocking how far past the expected moves. If you take a look at the IWM in some of the most recent weeks in its explosion to the upside, there's a breach of the expected move. There's a breach of the expected move. This week, we're all good. Okay, there's a breach of the expected move, breach of the expected move, huge breach. This week, just outside of it. If you look back, what this is saying, and I want to be crystal clear in what I am kind of saying to you, this is 1, 2, 3, 4, 5, 6 breaches of expected move, okay? And ultimately what? The most recent weeks. You got 6 breaches out of 7. That's no 68% of the time. And it's shocking. And it's the biggest change that we've seen in markets, okay, in recent years. Like, again, I've done a ton of research on this stuff, and markets don't just, oh yeah, don't take this stuff lightly. First of all, what does that translate to you? Like, you're sitting at home and you're thinking like, okay, great. We moved outside your expected move. What it means is that in recent weeks, you could have blindly purchased options on both sides of the marketplace. You could have bought a call and bought a put. That's it. Buy a call, buy a put. Then what do? Oh, I got down on my hands and knees and just prayed that we moved. And it worked. And how often did it work? Okay. Remember, these lines drawn on the screen, this is not some Fibonacci Bollinger Band pulled out of thin air. This is just taking the option premiums and plotting them on a week-to-week basis on the chart. And when you've got, 6 out of 7 outside the expected move, it literally means that 6 out of 7 times you would have seen a degree of profitability. Now, that's what I wanted to kick off with. We are moving, okay, into a period of it appears to be drastic inefficiency in a marketplace. And everybody always says the market's always right and the market's always completely and totally efficient. This is telling you otherwise. And, I'm not sitting here with an opinion. I am looking at, 6 out of the last 7. Now, 6 out of 7 times doesn't exactly make something statistically significant. I've got mathematics is, and I came from like the genre of trading, quantitative trading that looks at this stuff. I know that you have to have a subset of a couple of thousand, breaches before that makes it worthwhile. But it's striking that 6 out of the last 7 weeks, because you have to recognize there are billions of dollars, okay, being made or lost on things like these expected moves. And if you take a look also at products like the XLF, okay, this is the financials. There's a breach, there's a breach, there's a breach, there's a breach, okay? Week after week after week, take a look at the financials in here, all right? Here's a week we stayed inside. There's a breach of expected move. The very next week, a wild breach to the upside, wild breach to the upside, wild breach. Okay, this week, the same exact thing. So it's not just in one product. Okay, we're seeing this resonate in this most recent move. Now, let's move right to the financials because I've got them on your screen and I've got these auto expected moves up here. Why am I looking at the financials? I'm looking at the financials because one of the things that really stands out, we're coming into earnings season this coming week, all right? Most of the financials are going to be releasing their earnings, okay? When I say this week, we're looking at Thursday or Friday of this week. Now, you're going to hear earnings announcements from the likes of Bank of America. So Bank of America, is that heated up to the upside enough for you? Okay, Bank of America, in fact, look at this year-to-date percentage. It's up about 16% year-to-date. Why am I bringing up the financials? Like earnings, normally, I wouldn't like, oh, it's earnings, it's Apple, it's this. I think the earnings of the banks are of critical importance this week. Why? Have you not tuned in the last 3 weeks of trade? It's the banks that are driving, okay, the entire S&P. Take a look. Citigroup, okay, earnings coming up. These moves are staggering. Citi is up 25% year to date, okay? Because they're good at something? No, because they're sitting on huge, balances and the interest rates are going up. So whether it's Bank of America, JP Morgan, Citi, okay, Wells, we've got Morgan Stanley on the docket over here. We've got, Morgan Stanley's actually next week. Apologize for that one. Wells Fargo. All of them, for the most part, have earnings coming out. And what's striking about that, and I don't think enough people are going to be paying attention till later this week, is when you start to bring up, again, the XLF. As I come back over here to the XLF, you're coming into earnings, and the XLF is sitting on a 12% gain year to date. However, it just basically made that 12% gain inside of what? Well, the last month of trade. You're really about 3 weeks when we started gapping higher. All of those returns are what? Hey, listen, the numbers better be stellar out of the banks this week because that people right here is the driving force behind the S&P. Now that's, kind of your technical take, and it doesn't leave you with a warm, fuzzy feeling because you're a coin flip away from either exploding higher or falling flat on your face. The XLF, interestingly enough, the XLF options, they're not displaying inordinately high risk, okay, at this point in time, meaning there's just like the implied volatility is saying, whatever. None of the banks seem to have really high implied volatilities. And it's odd. It's very, very odd. And again, there's odd things all over the screen. But if you look at something like Bank of America, okay, and I'll tighten up the number of strikes. Look at Bank of America, and you're looking at this, 24% versus what, 22%. That's its earnings coming out, and there's barely any additional volatility. The marketplace is saying, who cares? Earnings, right? You take a look at something like what? Like JP Morgan? No, there's no bump in volatility. Citi has been on fire lately, just on fire in terms of its move. I mean, this is a move from what? It was up 9%. It's now up 25%. Okay? And it's implied volatility. Whatever. I think there's some great opportunities. And interestingly enough, I think it's going to be on the buy side of options. Now, as I mentioned, if I haven't really geeked out on you enough thus far, and again, what's really going to matter this week, obviously the financials. There's Fed minutes coming out on Wednesday, but it's the financials, I think, the end of the week. The earnings are very likely to take a toll on the marketplace. Okay, you better know what your risk is. And again, anytime it's earnings, it's a coin flip. It doesn't matter what you think. Okay, you got to see how these banks are actually performing at that point. All right. Now, as I said, I'm really going to geek out on you here for a minute. If I haven't already done so, we're going to cruise over and we're going to take a look at the spiders. Okay, I'm going to close up, this left side bar for the time being. And I want to show you something that, quite frankly, I haven't seen in the marketplace before. And I don't mind saying 19 years, trading. I started out in Chicago. I had families in my family that traded in this business all the way back to the 1970s. And, I've been kicking back and forth ideas to other traders and so forth. And none of us have actually seen this kind of develop before. And I'm going to show you exactly what we're talking about. So I started opening up option chains over here, maybe 13 days out. Just short-term stuff, and I'm going to open up, all right, a couple of options in here. One of the things that was really, really striking, and this has been going on most of this week, but I wanted to really update you on it. The options that are at the money, the at-the-money options, are showing an incredibly low implied volatility. Now, it's rare, very, very rare that we look at implied volatility, okay, of individual options, okay? The implied volatility averaged together, here again is these 13-day options, the implied volatility averaged together, and that's the entire chain, is almost 9%. So the average is about 9%, okay? But what you're seeing for the at-the-money options, 5.5%, 6.3%, you're like, wow, okay? Think about that for a second. There is what we term a massive, massive skew. And what's extraordinary about this skew, okay, on calls, typically speaking, calls, the at the money is higher than the out of the money. And what that means is it would go like 6% and then it kind of drops off. The skew drops off. And you can even do your own homework on this. You can go to the spiders. Okay, you can go to the spiders. If you're on Thinkorswim, great. If you're not, don't worry about it. Just go to the spiders and you go back maybe a few months in time. I don't know, just go back to like any weekend, a few months in time, and you go look at options that are about 13 days out and pull up stuff like what? Implied volatility. And what you'll typically see, and I'm showing you right now, look at, there's the at the money. Now forget that it's 15% or 11%, but what I want you to see is the volatility typically drops off the further you go out of the money. It should drop off the further you go out of money in the calls, and on the puts is the opposing. The puts, okay, the volatility skew gets steeper. So the puts kind of look like this, the calls kind of look like this, right? Being the at the money, okay, and then the calls kind of drop off, the at the money, and then the out of the monies increase. That's kind of what skew should look like. I started looking at the spiders and ruh-roh, raggy, okay? You've got the at the monies and the out of the monies. The out of the money options on the calls, they don't look like that, okay? They look like this, okay? In fact, the skew is even higher on those out of the money calls in some cases. So I started actually doing a bit of homework on this. I even went like 41 days out. You'll see it 41 days out. You can see it everywhere, okay? You'll see it everywhere inside of here. All of a sudden, the marketplace, are you kidding me? It's pricing risk to the upside. That's what that means. They're actually pricing risk to the upside. See, options are in effect supply and demand. And the only way this skew can get this, let's call it screwed up, the only way the skew gets this tweaked is if there's actually demand for these out of the money options. Now, do you look at that as being bullish or bearish? I don't care the way you look at it and how it's interpreted by you, but I'm telling you, this doesn't exist in index products. Okay, it'll happen once in a while at Apple before, like, oh, they're releasing a new iPhone. You don't see this stuff in index products. Okay, on top of it, option pricing right now is highly inefficient in my, that is an opinion, and I'm going to show you why I believe the option pricing is highly inefficient. Look where the underlying happens to currently be. Now, this is where I'm going to totally geek out on you. The underlying is currently at about close to 255. So I'm going to take the 255 calls and I'm going to add them to the 255 puts. Most of the time, the at the money straddle, most of the time this at the money straddle is equivalent to the expected move. Right now, they're nowhere near each other. The at the money straddle is only trading for $5, okay? But the expected move is showing $7.25. Is this equation wrong? I mean, I worked on a lot of these equations at Thinkorswim. The equation ain't wrong. It's not wrong. It's the way that this equation actually works and its implied volatilities, okay? What's going on, and appears to be going on, is that trading firms must be selling tons of at-the-money options and then just hedging and hedging and hedging and hedging. Well, in effect, supply and demand, they've actually created this huge supply, and it's pushing and pushing and pushing these implied volatilities down. Now, if I haven't geeked out on you enough for a second, okay, I'll take you through like a simple idea in this equation and how to say this is obscure is, it's not enough. I'm telling you, people, you may never see this, okay, in your trading career kind of again. The at-the-money straddle's trading for $5, but the expected move is $7. This is huge deviation. You're like, who's right? What's right? And the answer is, yeah, they're both right. It's, again, this effect of supply and demand that's actually distorted, okay, this skew. I'm going to take you through a quick equation over here. Whether you like it or not, it's going to take me 2 minutes, and it's worthwhile, okay? For those of you, again, that are a little bit more option savvy, if you look at the at-the-money implied volatilities, add them up and divide by 2. Seriously, just add them up, divide by 2. So one of them's like 8%, the other one's 6.3%. So take 8 plus, okay, 6.3% equals what? 14. Divide it by 2. Why did I divide it by 2? I divided it by 2 to give us the average. All I'm trying to do is just average what? These two at-the-money implied vols. The at-the-money implied vols, okay, for the most part, equal about 7.15%. Okay, so now I'm going to take you through a similar expected move equation. The expected move equation works like this. You take the number of days, I'm going to close this up for a second and just take you through what this equation is going to look like. All right, you take the number of days remaining to expiration. So it's the square root of 41, okay, divided by the square root of 365, okay? You multiply that by the volatility. Use the at-the-money implied volatility, which is roughly, okay, 7.15%, okay? Then you multiply that, okay, by the stock price. That's the equation, roughly speaking, for expected move. So let's do it. Let's actually show you some of the deviations in here. If you take, okay, what is it? 41 square root divided by 365 square root, okay, multiply that by what? 7.15, okay, which is really 0.0715 multiplied by what? Roughly the stock price. Let's just call it 254 equals, all right, $6.08. So to show you how crazy things are, I just use a quick and dirty methodology for calculating expected move. My expected move equation, my quick and dirty one, came out to basically $6 was my expected move. The Thinkorswim expected move is at $7.25, and yet the at-the-money straddle is trading for $5. Okay, the at-the-money straddle right now is trading dirt cheap, and again, it's highly inefficient marketplace that I believe that we're seeing. And I think it's all these trading firms that are selling at the money straddles. Okay, the more options that they start selling at the money, even in this environment, we're moving to a phase of inefficiency in the marketplace. What that could mean, you don't see the VIX higher, you don't see anything in terms of volatility over here. I believe, again, this means that there's substantially more volatility coming. We may have to redefine, okay, the word volatility. Why? Because markets are exploding to the upside, even though we're in a rather low implied volatility climate, one of the lowest VIXs ever. You may have to redefine how you actually, okay, again, define volatility, because volatility, for the most part, people think of these massive market moves. Well, we're seeing some fairly massive market moves, but the option premium isn't paying you for it. Says to me, you need to be on the buy side of options. Thanks everybody here for joining us. The Weekend Update. I'm Don Kaufman. Enjoy TheoTrade. Bye-bye.